Hello, everyone. Thank you all for joining us today for our third and final day of our 3-day third-party risk management bootcamp. We hope you found the last 2 days of this virtual camping trip valuable, as we've certainly covered a lot of third-party risk management material. My name is Jessie Redmond, and I will be your host. On your screen, you should see multiple widgets that you can use. If you are unfamiliar with our webinars or have not been on any of the bootcamp days so far, all the widget boxes are resizable and movable, so feel free to move them around to maximize your screen space. At the bottom of your screen in the toolbar are icon buttons you can use to show and hide the widgets. If you experience any issues or have technical questions, you can use the Help widget or submit them along with any other questions through the Ask Question widget. We keep track of all questions throughout each session, so you'll hear to answer some live, but those that we can't get to right away, we will address with you via email. Before we get started, let's recap a bit. In day 1, we covered criticality and risk ratings, risk-based vendor due diligence, critical vendor contracts, and fourth and nth party vendors. Yesterday, on day 2, we talked about vendor cybersecurity posture, business continuity, and disaster recovery within your cybersecurity program, vendor SOC reports, and managing AI risk. This brings us to today, the third and final day of the bootcamp, where we'll start with vendor financial health in today's business climate, followed by regulatory requirements and expectations in third-party risk management. After that, we'll take a brief 10-minute break. After the break, we'll cover top third-party risk management program metrics and reports and understanding vendor exit strategies and third-party risk management closure. Before we get started today, in the related content widget, you'll see a link to a copy of today's slide deck, a link to our website, a link to our samples library, a link to our resources library, which has thousands of educational resources, and links to several specific resources that we feel will be helpful if you'd like to learn more about certain topics discussed today. Underneath the slide area and next to the related content widget is a graphic showing the third-party risk management lifecycle. This will be helpful to reference throughout today's sessions to understand at what point these topics fit into the overall third-party risk management process. Today's live sessions are eligible for up to 2 CPE credits, 1 per hour. If you wish to receive these credits, please remember to answer all of the polling questions that will appear on your screen during each session's presentations. You will also be sent a follow-up survey link 24 hours after the bootcamp has concluded, tomorrow, April 19th, that will need to be completed in order to receive the CPE credit. For the next hour, Raman Zachariah, VendMinder's Chief Financial Officer, will join us to discuss vendor financial health in today's business climate. Then Christine Kitamura, VendMinder's Senior Content Manager of Education, will join us to discuss regulatory requirements and expectations in third-party risk management. With all that being said, I would like to hand it over to Raman. Raman, the floor is now yours.
Thank you, Jessie, and thank you all for joining today. We'll walk through the agenda and then we'll tick through the content and hopefully answer many of your questions throughout. So today we'll talk about why financial health reviews are critical even in uncertain economic times, especially the times we live in. We'll also learn about how performing financial health reviews and how to start and why it's important to get started as soon as possible, especially on those critical and high-risk vendors. And then we'll talk a little bit about key information to utilize and how to obtain it. And finally, we'll end with some red flag reminders and some takeaways on when you arrive at the risk ratings on your vendor financial health reviews. So let's jump right in. So when performing vendor financial health reviews, it's always good to start with the what, the why, and the when. What are financial health reviews and financial risk, and how is it important for your organization? So it's the likelihood that your organization could lose revenue or lose some sort of stability given a vendor or third-party relationship and a poor financial health profile at that vendor. And examples of a poor financial health profile at a vendor could look at declining revenue, lack of profitability or declining in profit, and other areas like increased liquidity pressures, low cash balances, or beyond the quantitative numbers, risk factors such as data breaches or any sort of litigation or legal obligations that they have. The why centers around why you need to do financial health reviews, and it's making sure that you're doing them to ensure a vendor can support their contract and therefore your business. The more critical a vendor is, the more important it is to understand their financial health in their profile over time, and then when to do it. Typically, you'll want to do financial health reviews pre-contract, either at the point of vetting or on an ongoing basis to make sure that you're deep diving into their profile and making sure that you're staying on top of the changes year to year or period to period of their financial health reviews, because their financial health could change materially over one period versus the next. So it's a good reminder as to why third-party risk management is even more important in a struggling economic climate. It's a well-known fact that we faced a lot of different challenges over the past few years between the pandemic, the supply chain issues, between bank failures, between all of the global wars and geopolitical conflicts, and then broadly other macroeconomic events. What these challenges do is they present a lot of issues for businesses, but also it's an opportunity for you to understand how resilient your business can be and mitigate some of those risks that arise at vendors. So third-party risk management and financial health review should still be a priority of your organization, even in these downtimes or in this time of financial hardship, because they can prevent, in many cases, other issues that you as an organization may be facing and your vendors could be facing if you don't identify those risks in advance and work to mitigate them. Beyond that, we've seen a lot of companies, and maybe you are also privy to this, but folks, when there are downtimes, they tend to reduce costs or let folks go from staffing or tooling. So regardless of whether you are part of that or have made it through that and are perhaps thinking about this into the future, continue to reinforce things, especially on those critical parties, because if you don't, it could ultimately lead to new risks that are introduced that ultimately could introduce intermediate or long-term risks to your organization beyond just what a macroeconomic environment may present to them. So let's dive into why it's important to do vendor financial health reviews in this circumstance. So it's good to start with 6 key areas to give you an understanding on the why, especially in this tough economic time. 1, every third-party relationship is really meant to solve a problem or realize an opportunity. So when vendors are storing sensitive data for your organization or helping you increase revenue and market share, these third-party relationships need to deliver their value to your organization. And if they have some sort of risks to ultimately prevent that or create a disruption, that could pose more risk than not doing this oversight at all. Beyond that, it's important to make sure within your third-party risk management workflows that your contractual service levels are met and then everybody is hitting those SLAs. And we'll talk a little bit more about those later on. And as to how you can do them with financial health reviews as well. So you need to make sure to enforce them, especially in these tough economic times, because those SLAs are there for a reason. They're making sure vendors stay on top of their performance. Third, we really need to understand the accountability. So again, going back to those SLAs, making sure that vendors and service providers are accountable to your organization in terms of delivering what they said that they would, again, increasing your revenue growth, your cost management goals, or again, providing that critical data storage for you or data processing. Without third-party risk management, you can't enforce that obligation to vendors, and you may lose sight of what's important within your contracts. So doing third-party risk management is important for that enforcement perspective. And beyond that, another reason to really understand is making sure that you're getting clarity as to what risks may exist with these beyond just individual vectors that we'll talk about today, like financial health. But there's an interconnectivity between the world today. So with that, vendors also may have a profile that expands beyond just the financial health. So data breaches, cyber attacks, operational failures are actually tied on to something that we call the domino effect. We'll talk a little bit more about that, but it's important to do third-party risk management and understand the collaboration between these different domains and these different risk vectors. And in order to do that, you have to have a proper third-party risk management program and processes in place, even in tough economic times. And finally, 2 other reasons to really understand the why it's important to do third-party risk management in a struggling economic climate. It helps ultimately protect your organization and your own customers from these negative impacts that may result from third parties and vendors you have relationships. It's not a nice to have in certain circumstances. For many of you that are regulated by different agencies or governing bodies, it's a regulatory requirement, so it's a must-have. But beyond that, even if you're not under regulation, it's a must-have from just an operational resiliency perspective and even from a reputational risk perspective. And to end, one last reminder on why it's important. Sufficient investment in your third-party risk management team helps protect your organization's assets, ultimately your organization's revenue and its customers that generate that revenue, and finally meet those legal and compliance needs that your internal or even external folks that monitor your legal and compliance posture look for when looking at your own business's organizational processes and procedures from risk management. So now that we understand the why, let's actually start digging into financial health assessments. So this is an example before we dive into the what and the how in financial health. Some consequences of not having financial health reviews and proper third-party risk management practices. Again, if you cut corners in tough economic times. One example is you sign a contract with a new vendor with poor financial health and you didn't do your proper screening and identify key red flags during that pre-vetting or pre-contracting phase. You could, if you did financial health reviews, work to mitigate them or avoid them entirely by going to a different alternative vendor. But if you don't do the reviews, you can enter into a long-term contract with poor financial posture, a vendor with poor financial posture, which ultimately will hinder your organization's operations in the future. Beyond that, you may not be able to serve those customers if eventually some sort of unexpected event that you could have got ahead of with your third-party risk management and financial health review practices. And that may lead to disruptions in your operations because of that third-party disruption as well. And again, you could have gotten ahead of it by mitigating some of those concerns pre-contract or even at point of renewal, or even just by asking the vendor what they're mitigating these diligence findings on. And finally, another consequence is you may not actually be able to scale or meet your growth and organizational goals. So vendors are there, again, to help you also help grow and move faster in certain circumstances. So having those proper procedures in place from a financial health review perspective work to help you understand whether or not your vendors are up to snuff to continue to support their growth. If you want to move faster or you want to scale more to them because you're outsourcing a service or a tool to them, it's important to make sure that they can support that as well and can support your growth. So it's not all about preventing always the negative, it's also enabling the positive in many respects. So where do you start? Let's dive right in. From a perspective of financial health reviews, if this is new to you, you're at the right place. Getting started can be as simple as creating questionnaires on key financial information you want to review before you sign a contract with a vendor, or if you're at a point of renewal, or just frankly, if you're just doing some annual procedures or regular procedures. But it can also be as complex as doing deep dive financial health assessments, thorough due diligence reviews, and using other tools and systems from a monitoring perspective for vendor financial health reviews. So we'll talk about that on the next slides, but this is a preview into that. So as I mentioned earlier, the domino effect of declining financial performance and financial health with your vendors can be very crippling. So this could ultimately be your organization without these financial health reviews when you're dealing with third parties that may have a poor financial health profile. When a vendor may have declining revenue or declining income, it ultimately means they may have to make cost cuts. And then what happens when they make cost cuts, they're actually removing staff. Removing staff could hinder service levels and response times, which ultimately may lead to exposures of other risks like certain privileges, perhaps being exposed to a third party that wants to perform a data breach or some certain privacy breaches as well. So at the end of the day, financial health is important to review in isolation, but beyond that, it has impacts across a vendor's profile outside of just the financials. So this is where the domino effect needs to be taken into account. So to avoid the domino effect, where do you start today? So first, it's always good to start simple. Prioritize conducting financial health reviews on your key critical vendors. So however you define criticality within your third-party risk management program is important to start with. You also want to define a regular cadence, meaning how often you're doing these financial health reviews. At a minimum, it's best practice to do them annually on those critical vendors and key vendors, but you can do them as frequently as quarterly or monthly as needed. And you'll want to collect financial documentation either in the form of some sort of statements or even just in the form of questionnaire responses. Beyond that, you really want to craft a methodology on performing financial health reviews, what type of information you're reviewing, how you're going to review it, and ultimately how you determine a risk scale that's consistent with your other third-party risk management practices across other vectors in your organization. And again, you'll want to collaborate with other team members because, again, financial health is only one piece of the overall puzzle. There's many parts of a third-party risk management program that's properly put into place. One reminder for all of you to leave you with. Don't wait for any sort of regulatory guidance or even someone internally to define where you should start. There's no perfect time, so the better you can get started and the faster you can get started in terms of just starting simple and then being able to iterate that and improve it is better than waiting for someone else to tell you or define how you should get ahead of these reviews. And with that, we'll go into the first poll question of this session. Jesse, go ahead and take it away.
And this brings us to the first poll question of the day. You should see the poll question now in the slides area. If you have any issues, please feel free to send us a message using the Ask Question widget, and we will be happy to assist. Please remember, if you wish to receive the CPE credit for today's session, you must answer all poll questions and be in attendance for the entire live session. This first poll question is, do you utilize a system and/or internal resources today to perform vendor financial health reviews? Yes, only full-time staff that perform reviews, but no tool. Yes, only a software tool, but no full-time staff. Yes, we outsource vendor financial reviews to a third party and have a tool. Or no, none of the above. Raman, we have some time now to answer one of the questions that has come in from the audience. And this question is, how often should we perform financial assessments and monitoring on vendors?
Thank you, Jesse, and thank you all for joining us today and for this thoughtful question. In terms of performing financial reviews, at a minimum, you should be doing them on an annual cadence, especially for those critical vendors or those high-risk vendors within your vendor base. But beyond that, and in between those annual reviews, you can also put those same vendors or other vendors that you may not be doing an annual review on a continuous monitoring slot using some source of information that you can dig in further on. And that continuous monitoring slot may provide you some insight into the changes of the vendor's financial profile, business health profile, or credit risk profile that you can ultimately then use to trigger some sort of oversight task or some sort of due diligence task like sending a questionnaire or actually performing a more robust, full, in-depth financial health review. So at a minimum on an annual basis, specifically for those critical and high-risk vendors, even on non-critical vendors, you can choose it on an annual basis, but you can also use more regular monthly or quarterly slots of continuous monitoring to keep track of their performance over time. Back over to you, Jesse.
Thanks, everyone, for answering that poll question. Here are the results. By the way, you may have noticed reactions such as a thumbs up or heart coming across the screen. If you find this feature distracting, you can turn it off by clicking the 4 arrows in the top right-hand corner of the slides widget, which will expand the slides to full screen and no longer show the reaction. Before we move on in the related content widget, please be aware that we've provided our 3 vendor financial statements to review infographic. This is a handy resource to grab as it walks you through the financial statements overview, which to review in each one, and the value of each one. Back to you, Raman.
Thank you all for that poll, and thank you, Jesse, for passing it back along to me. So why it's important to centralize in a tool or in some sort of process and procedures. We do an annual third-party risk management white paper, and vendor financial health was ranked in 5th place based on our latest one in terms of how important it is or how relevant it is to your risk management program. So having some sort of centralized tool or process is very important broadly, but especially important for vendor financial health risk because, again, you can point back to this when you're getting examined or audited from an external party. So having something in place, again, is better than nothing. Even if it's just a spreadsheet, it can drive a lot of efficiency when you're in a position to actually produce some sort of information on the risk levels of your vendors and the oversight that you're performing on them. So let's dive into some of the key financial documentation to collect on vendors. It's good to separate it between quantitative and qualitative. On the quantitative side, you want to focus on the 3 financial statements of interest: income statement, balance sheet, and the cash flow statement, and you'll want to collect at least multiple years of this at a minimum. You should also ask for audits when possible because those are the gold standard, but sometimes you may not get audits, so it's good to ask even for unaudited financials if that's important to you to get ahead of the reviews. Beyond that, it's good to combine the quantitative metrics with the qualitative side. So this is commentary and analysis and context provided by typically management or an auditor in the form of the following areas. You want to focus on key risk factors and things like litigation, legal exposure, and anything that could introduce new risk to your organization to support the numbers that you've reviewed. From a quantitative ratio perspective, you want to also get ahead of identifying red flags. So these are nice rules of thumb, and this is not an exhaustive list by any means, but these are commonly seen ratios that you can use from the 3 financial statements and come up with these to help get ahead of some of the red flag identification and other areas you're looking into. Again, this is not exhaustive, and we have a lot of collateral available online for free if you would like to get an understanding of any of these in more detail. From a qualitative side, similarly, you want to dig into some of the key areas. Many times there's a lot of qualitative information, especially when you're looking at a large public vendor that has available financials in the public domain. But you want to isolate some of these areas. And again, this is not an exhaustive list, but this is what we've seen in best practice doing thousands of these over the years. Things like the going concern opinion from an audit report is important, and other areas like legal litigation, credit risk, subsequent events, any sort of risk factors that a vendor identifies, or any sort of issues that they've had internally with, say, cyber breaches or disaster recovery or any sort of fines. These are all key areas to pull out of financial statements and text and commentary that's provided in the footnotes therein. So keep these in mind and keep this almost as a reference checklist when you're doing your financial health reviews from a qualitative point of view. So we often get questions on how you get information from vendors. From a public vendor standpoint, it's quite easy. They make that information available on different websites, specifically for U.S. companies on the SEC, the Securities Exchange Commission's EDGAR website. They file those quarterly as well as on an annual basis with an audit. CEDAR is the corporate website for Canadian public companies, but beyond that, there's also international public companies that link them directly on their website. So you can always also request them directly from public vendors as well, but it's easy as looking at these publicly available domains, finding public vendors. On a private vendor side, it's a bit of a mixed bag. So typically you want to deal directly with the vendor and ask them for what you'd like. So audit statements are the best of the best. You want to ask that first, but if you can't get audited statements, you can send inquiries that are more direct into what you're looking for, whether that be unaudited financial statements, a management letter, or even utilizing, if all else fails, some sort of public source like a Dun & Bradstreet credit report, an Argos credit report, or some other searches that you can take into account when performing some high-level oversight and due diligence reviews on said vendor. Beyond that, you can always request check-in calls or even just do a 30-minute call with a vendor to get the walkthrough of the key information that you want to articulate within your vendor financial health reviews. That's always available to you, regardless if the vendor is public or private. So you may be asking why it's important to combine the qualitative side with the quantitative numbers. Really, the rule of thumb is the numbers themselves don't tell you anything without the context, and the context isn't always important without combining with some sort of quantitative measures. So combining both helps you identify an area of full comprehensive risk, and once you identify those risk ratings and you ultimately review the vendor's financial health performance on those risk ratings, you can make a determination if that risk level is appropriate for your organization's risk appetite, or you can, if the risk levels are too high, work to mitigate that by working directly with the vendor or looking for a new vendor. So that's why it's important to keep this all in mind at the highest levels. And then beyond that, it's important to also do, as I mentioned earlier, vendor financial health reviews on a regular cadence. It's important to do them annually, especially for those key critical vendors, but oftentimes you may need to do them more regularly because you got to get ahead of some of the risk that you've identified and make sure that the vendor is mitigating it. So it's important to do this not just once, but also on an ongoing basis, because vendor financial profiles can change drastically from period to period. As you've probably seen through some of these challenging economic times, a low risk or a confident risk vendor could change overnight with, say, supply chain or new risk factors or bank failures. So it's always good to keep this as regular as possible within your broader risk management program. And with that, we'll go over to our last poll question of this session. Jesse, go ahead and take it away.
Our second poll question of the day is, do you perform financial health reviews on your vendors today? Yes, only on critical and high-risk vendors. Yes, on every vendor we contract with. Yes, but no recurring process or organization is done on an ad hoc basis. No, none of the above. Raman, have another question here that we can answer. And this question is, what qualitative information is most important and critical to review in our financial health reviews?
Thank you, Jesse, and thank you again for a thoughtful question. In terms of qualitative information you'll want to complement the numbers with when performing a financial health review, you'll want to look at management discussion and analysis and footnotes within financial statements that center around disclosing things like legal issues or litigation that is outstanding with the vendor, any sort of commentary from the management team around trends of the business as it pertains to growth, investments, risks that they may have done, and more broadly, some context behind the numbers. And then beyond that, looking for things like concentration of customer relationships or vendor relationships, any sort of debt commentary on their debt and legal or liability obligations is also important. And when you're digging in through that, tend to look at trends or any sort of commentary that may suggest a red flag, because that could ultimately put a little bit of context behind some of the numbers you reviewed. Again, you don't have to read every footnote or every word, but oftentimes you should focus on some of those red flags or potential red flags to add some context to the numbers you're reviewing. Back over to you, Jesse.
Okay, here are those results. Thanks again, everyone, for taking the time to answer the poll. Before continuing, I would like to direct your attention back to the related content widget, where you will find our 6 actions to take after reviewing a vendor's financials infographic. Grab this resource to review the important actions to take to ensure you have the insight needed to mitigate and lower risk. I'll hand it back to you, Raman.
Thank you all. We'll end with a highlight of a number of red flags to look for when you're doing financial health reviews in 2024 and beyond. So declines in revenue and profitability, cash flow and liquidity issues, and then any sort of material breaches or sort of adverse media are very important red flags to keep in mind. Also, customer concentration or any sort of churn is indicative of a red flag you should double click into and perform more oversight. So again, this list isn't exhaustive, but gives you an idea of the things to look for when you're doing vendor financial health reviews. Beyond that, performing ongoing monitoring is also important. So again, regular cadence of those annual reviews is good, but between those annual reviews, you can also put vendors on ongoing monitoring to see how their changes in profile may necessitate some sort of additional oversight or additional due diligence. So these are some questions to ask yourself when you're doing monitoring to ultimately determine whether or not you need to do further due diligence and mitigate the risks that have been identified therein within your financial health reviews. And finally, to end, here are some key takeaways on vendor financial health reviews. So if you're considering downsizing your financial health reviews and your TPRM processes, focus on critical and high-risk vendors at a minimum, because those are your best bang for your buck, again, in this challenging economic time. Beyond that, try to do them as regularly as possible, particularly on an annual basis, so that you avoid things like the domino effect. And understand you're not going to get everything right or fully comprehensive, but it's always good to start somewhere. And finally, use your contracts, both pre-contract and on a renewal basis, to enforce what you need to enforce. You'll want to make sure that you're centralizing all of your findings and then ultimately your follow-ups with these said vendors. So again, if you ever get the question, you can work to mitigate it thereafter. So with that, we'll end the session. Hopefully you found this very helpful, and look forward to your questions later on.
Great. Thanks so much, Raman, for that informative session. I'd now like to introduce Christine Kitamura, VinMinder's Senior Content Manager of Education. She will discuss third-party risk management, regulatory requirements, and expectations. One quick reminder that below the slides area, you will find the life cycle showing where this fits into the process. Christine, the floor is yours.
Hi, everyone. As we continue with this first session of the day, I'll be speaking about some of the regulatory expectations that apply to third-party risk management. I'm sure this is probably a popular topic considering the interagency guidance that came out last year, but I'll also be focusing on some of the other regulations and guidance that are important to know. So for the agenda, I want to discuss some general regulations and standards that apply to third-party risk management. Many of these actually don't even use the term third party in the title, but I'll explain why they're still relevant for your third-party risk management program. I'm also going to describe some of the common themes of these regulations and some examples of regulations that apply to a specific industry. You'll also learn some enforcement actions that occurred in 2023, as well as some tips to maintain compliance in your third-party risk management program. And finally, I'll provide some tips on how you can review or self-audit your program and how you can think like a regulator, which helps identify any gaps or issues that may need to be addressed. To start off, let's look at this idea of third-party risk and the law. As you can see here, there are several industries that are very reliant on high-risk or critical third parties. Now, what this means is that industries like consumer business, financial services, healthcare, and technology are all dependent on third parties to provide products and services. And if those third parties are unreliable or unsafe in any way, that could create some significant consequences like a healthcare organization or a financial institution not being able to function. So in order to make sure that these industries are engaging with their vendors in a safe way, we have all of these laws and regulations in place to protect the organization and its customers from harmful situations. And I just want to say a few words about specific regulations and general laws. As I mentioned, there are several laws and regulations that apply to third-party risk management. Some of these laws apply to every organization across different industries. So whether you're a large financial institution or a smaller tech company, these are laws that everyone has to follow. Fortunately, many of these regulations cover the same concepts. They were just created by different regulators, kind of similar to how local, state, and federal laws are also created by different levels of government. Some of the regulations are specific to a single industry, like finance or healthcare, while others are focused on a specific aspect. So data protection is a really big focus area for regulators, and any organization that deals with sensitive information would be required to follow those regulations. That could apply to industries like information technology, insurance, legal, and education. Here are some examples of general regulations that you may be familiar with. I won't go through each one in too much detail, but I'll cover the highlights so you can see how they apply to third-party risk management. The first one is the Sarbanes-Oxley Act, which applies to all public companies. This is one of those laws that doesn't make a direct reference to third-party risk management, but it focuses on areas like internal control assessments, which can extend to your vendor relationships. The next three are related to preventing and detecting corrupt practices like bribery. Under these laws and standards, they're basically saying that it's not enough for an organization to abstain from corrupt practices. They should also be doing their due diligence to ensure that their third parties aren't engaging in bribery. And the last one is specific to organizations in California and requires them to disclose how they're preventing human trafficking within their supply chains. Here we have some more regulations that can extend to your third-party relationships. A lot of these might be familiar because they're pretty basic standards that nearly every organization has to follow. The first regulation is related to the U.S. Civil Rights Act, which is intended to prevent employee discrimination. And the next couple of laws are related to topics like minimum wage and equal pay. Next, you'll see the California Privacy Rights Act, which is just one of many state privacy laws that are currently in effect. And I'm actually going to cover state privacy laws in more detail later on in the session. The Children's Online Privacy Protection Act is a federal privacy law to limit how organizations can collect and disclose a child's information. And finally, the Occupational Safety and Health Act of 1970 ensures that employers are providing safe working environments for their employees. The main thing to remember is that you want to make sure that your third parties are compliant with the same regulations and standards that your organization is following. It's probably not possible to have in-depth knowledge of all of these regulations and standards, so it helps to understand some of the common themes instead. On one hand, the guidance is designed to protect things like civil rights and employee and consumer safety. The other common theme is establishing safe and sound business practices. So many regulations give guidance on how to effectively manage risk and prevent fraud and corruption. Oversight and accountability is another common theme in a lot of these regulations. Remember that a lot of the requirements are simply reflecting common sense and ethical behavior. I think we can all agree that safe working conditions, data privacy, and fair labor practices are all important, so it makes sense that regulations are in place to address these topics. And a helpful tip when thinking about regulations is to consider inherent vendor risk. This can refer to things like information security, financial, and geopolitical risk. There are various regulations that address each of these risk types and help protect an organization and its customers. Here are just a few other considerations that are good to know. Some regulated industries may have more than one regulator, and if you're just getting started with building a third-party risk management program, it's important to first identify your regulators and the regulations that you need to comply with. Another important thing to note is that guidance isn't enforceable by law. So guidance is actually considered a best practice or a set of recommendations on how to comply with a law or regulation. This basically means that some aspects of the guidance may not apply to your organization. And if you find that your current practices are straying from the guidance, you'll need to have documented evidence for how you're still following the law. One of the reasons why you don't need to memorize all of those regulations is because they can change over time. Before these changes go into effect, regulators will release their proposed updates and ask for public comments. And whenever a proposed change is made public, it's a good idea to review the content and look for any changes that you might have to make in your organization. Once the regulators review those comments and officially make those proposed changes, they'll release the final regulation with the effective date. So next, let's review some notable third-party risk management regulations from 2023. Of course, the most notable one is the Interagency Guidance on Third-Party Relationships, which went into effect in July of 2023. This guidance applies to all banks and expands the scope of third-party risk management by stating that all business arrangements should be included. One of the main themes of the guidance is using a risk-based approach, which just means that your critical and high-risk vendors should be assessed, monitored, and managed with the most scrutiny. Subcontractors or fourth parties are also mentioned in the guidance, and regulators clarify the oversight responsibilities of the board and senior management, especially when it concerns critical activities. And there's also more detailed recommendations on what to review during the due diligence process. The FTC Safeguards Rule is one that was amended in 2023. One of the highlights from that amendment is the clarified definition of a financial institution, which now includes entities like non-bank lenders, mortgage brokers, and auto dealers. This rule is concerned with protecting customer information, and one of the requirements is that covered entities need to retain a qualified individual to implement an information security program. This individual can be internal or external to your organization, but they need to have the skills and experience to oversee the program. And if you do choose an external individual, remember that your organization is still held accountable for those information security risks. The amendment also requires a certain level of reporting to the board of directors or governing body, at least annually. That reporting should include details about how the organization is complying with its information security program and details on service provider arrangements, which are your third-party relationships. The Safeguards Rule also provides details on how an organization should develop, implement, and maintain an information security program. Another requirement is to regularly monitor and reassess your service providers based on the risk to your organization. So again, this follows that risk-based approach that I mentioned before in the interagency guidance. Organizations must also have written incident response plans that describe how they'll respond and recover from a security event like a data breach. And a separate amendment from October requires organizations to report certain security events within 30 days of discovery, which still applies if that event originated at a third-party service provider. Similar to that amendment I just mentioned, the SEC also came out with a breach notification rule, which went into effect in September of 2023. Organizations that are regulated by the SEC are required to describe their cybersecurity programs in their annual 10-K filings and report cybersecurity incidents by filing a Form 8-K. The timeline of this notification is quite a bit shorter than the FTC safeguards rule and needs to be done within 4 days if the incident is material. And third-party service providers are mentioned throughout this rule, so keep in mind that these requirements also apply if the incident occurred with a third-party vendor. In addition to financial institutions like traditional banks and other public companies, credit unions also have cybersecurity reporting requirements. The NCUA made their cyber incident notification requirements effective in August 2023. The NCUA's rule gives a shorter timeline of just 72 hours to report an incident. Similar to the other rules I mentioned, credit unions would have to report certain details like a description of the incident and what business functions or sensitive information was compromised. The rule also applies to any third-party cyber incidents and requires credit unions to document all incidents, even if they don't meet the NCUA's reporting criteria. That reporting criteria is described here and basically says that a cyber incident is reportable if it can lead to one or more of these outcomes. The first would be a substantial loss of confidentiality, integrity, or availability of an information system. The second outcome would be a disruption to business operations, and that last occurrence is directly related to third-party service providers. When a third party suffers a breach or some other cyber attack that impacts the credit union's sensitive data, that would qualify as a reportable cyber incident. Moving on to those state privacy laws, this can be a challenging topic because different states have slightly different requirements. Each of these laws goes by a different name, but the overall intention is to make sure that organizations are collecting and handling consumer information in a certain way. So California's CCPA was the first law to go into effect in 2020 and has since been amended by the CPRA. The law is pretty comprehensive, but some of the highlights include obligating businesses to give notice or transparency when they're collecting consumer information. Businesses are also required to perform risk assessments on how they're processing personal information. And looking beyond 2024, there are several state laws scheduled to go into effect in 2025 and even 2026. I know this can seem challenging to keep track of all these state privacy laws, but you can actually find legislation trackers online that do a good job of showing you the status of each one. The International Association of Privacy Professionals has one of these trackers that's helpful to show whether a law has been introduced and when it's been passed and eventually signed. Until there's a federal privacy law, it's likely that each state will continue creating their own version, so it's important to keep track of the ones that apply to your organization. And just tying this back to third-party risk management, remember that you should make sure your third parties are complying if they have access to any sensitive information. And finally, the last type of regulation I want to mention is related to climate change and ESG reporting. Just recently, the SEC has excluded Scope 3 or vendor emissions from their climate-related disclosures. And this would have required covered entities to disclose emissions that come from their third parties or supply chains. However, I do want to note that Scope 3 disclosures are required in other regulations in California and the EU. The OCC, FDIC, and the Federal Reserve also issued guidance on principles for climate-related financial risk management. This guidance states that organizations should consider the financial risks of climate change and that third-party operations should be included in operational risk management. And before we move on in the session, it's time for our next poll question.
Our third poll question of the day is, what do you consider the biggest challenge in meeting third-party risk management regulatory requirements and expectations? Regulations are too broad or unclear. We don't have enough resources to stay updated. Our third parties don't prioritize compliance. Regulatory updates and changes require time-consuming reviews of our policies and procedures, or other. Christine, I have another question here that we could go ahead and answer.
Okay.
What's a good resource to stay updated on regulatory changes?
Well, I wish I had a simple answer for this, but as far as I know, there really isn't a single resource that covers every update on third-party risk management regulations. So I think you might have to try a few different strategies. First, I would say it helps to just set a few Google alerts for whoever your regulators are, and maybe even subscribe to their newsletters so you can see any updates or changes that they announce. Another thing that can help is to follow or subscribe to a relevant newsletter from either a law firm or a consulting firm, because those will often provide interpretations for a lot of these regulations and give you best practices on how to comply. Some of these regulations can be super long and complex, so it helps to get some insight from these firms who can explain them in a simple way.
And here are those results. Thank you everyone for answering this question. By the way, in the related content widget, you will find our third-party risk management regulatory guidance document. This document contains specific regulations based on industry, so be sure to take a look at this handy resource. Let's continue with the presentation. Back to you, Christine.
Moving on from those regulations and guidance, I want to focus on some of the enforcement actions that are related to third-party risk management. The first one actually settled early this year and resulted in a healthcare organization being fined $40,000 for a HIPAA violation. The provider has to pay the fine and also conduct an audit of its third-party vendors. The next two enforcement actions were given by the FDIC. Lineage Bank was required to improve its third-party risk management program, and First Fed Bank was found to have engaged in unsafe practices with one of its fintech partners. And these consent orders aren't restricted to healthcare and financial industry, because Rite Aid actually had an issue from using an AI service provider. The FTC actually prohibited Rite Aid from using facial recognition technology for 5 years, and they're required to implement a comprehensive information security program. So with that being said, it's important to understand how to maintain compliance in your third-party risk management program. Even though those enforcement actions don't always result in heavy fines, there's still a significant investment of time if your organization has to make improvements. So when thinking about compliance, it can help to consider 3 areas: your strategy, your activities, and your documentation and reporting. Your strategy should include an awareness and understanding of the regulatory requirements, as well as a tone from the top approach where your board of directors and senior management are communicating the importance of third-party risk management. Activities should be effectively identifying, assessing, and monitoring your third-party risks. And your documentation and reporting should clearly communicate oversight roles and duties, and should show the effectiveness of your activities. One of the most effective ways to determine if your program is compliant is to perform a review or a self-audit. Professional auditors and examiners will, of course, have more experience in evaluating third-party risk management programs, but it can still be a really beneficial practice to review your program yourself and identify any gaps or areas of improvement. These reviews can be formal or informal, and it's a good idea to focus on processes at the individual level instead of evaluating your program as a whole. So when you do these self-audits, you'll want to identify and document any remediation plans and timelines and follow through with closing the gaps. Just to give you an idea of what that self-audit might look like, here's a sample process review. You'll see that we're only looking at the process of due diligence. In this case, you might want to select just 2 critical vendors and 1 high-risk vendor for the review. First, you would look at your policy to see what the requirements are and who's responsible for performing each step of the process, such as requesting information from the vendor and reviewing and documenting the findings. Next, you can review the process itself to determine whether it was followed consistently and how the evidence was documented. The evidence should generally include the items listed here, like an inherent risk assessment, questionnaire, various documents from the vendor, and a review from a subject matter expert. In addition to the due diligence process, you'll want to make sure that you also have appropriate monitoring activities in place. So things like periodic risk monitoring, testing, and tracking open vendor issues. When doing these self-audits, try to think like a regulator by asking yourself these questions. These can help identify any gaps or areas of confusion if you don't fully understand the requirements. So these questions basically help ensure that your organization understands what it's required to do and that you have documented proof that you're meeting those requirements. And they also help verify that you have an effective process in place to identify and resolve any non-compliance issues. Finding issues when you go through those self-audits is not unusual, and you might find some of the issues listed here. Maybe your processes are inconsistent or your stakeholders aren't following the processes exactly how they're written. And if you do find any issues in your processes, you'll want to take these steps. First, document the gap, determine the root cause, and then identify a remediation plan so you can then communicate the issue to the appropriate stakeholders. And remember to keep track of your progress and formally close the issue once it's resolved. Always make sure to prioritize your remediation plans because that's something that auditors and examiners are going to focus on. As we wrap up this session, here are a few key takeaways that I hope you'll remember. Third-party risk management regulations and guidelines are essentially best practices and common sense. Make sure you know which regulations apply to your organization and review and self-audit your program to identify where you might have compliance issues. If you do go through an exam, just remember to prioritize a remediation plan and track your progress. I hope this session has been helpful, and thanks so much for joining today.
Great. Thanks so much, Christine, for the informative session. Before we move on to our next session, where Hillary Dewhurst will discuss the importance of vendor performance management, we're going to take a quick 10-minute break. Please meet us back right here in 10 minutes. You do not need to close out and log back in. Just simply leave everything as is. We do recommend refreshing your connection at the top of the hour to ensure you're ready for the session once we return from the break. Thank you. Welcome back, everyone. We'll now move on to our next session, Top Third-Party Risk Management Program Metrics and Reporting, that will be presented by Hillary Dewhurst, FinMind's Head of Third-Party Risk Education and Advocacy. If you'd like to familiarize yourself with where it fits into the overall third-party risk management process, please be sure to refer to the life cycle image located below your slides area. Hillary, the floor is now yours.
All right, for this session, we are going to be talking about third-party risk management metrics and some of the reports that you should have on file for your third-party risk management program. When it comes to third-party risk management reporting, it's really important to remember that, third-party risk management is a pretty complex practice. It's got a lot of components, a lot of processes, and a variety of stakeholders. So we really need that quality reporting for a lot of reasons. The first of which is to keep our senior management and board informed about relevant issues, including things like our critical vendors, how our internal compliance is doing, and just the overall health and effectiveness of our program. We also need to make sure that we're using reporting to confirm that important risk management activities are taking place on time, and that we are managing and tracking related program issues. We use that reporting to analyze our internal compliance and even think about things like how much capacity we have. We want that reporting to also serve as evidence of that program effectiveness and compliance that we can share with auditors and examiners, as well as the more obvious function, which is to provide information to stakeholders and drive action. Now, while there's an endless number of reports you can generate, let's talk about a few essential reports that every program should have. We want to have really robust and complete third-party inventory reports that allow us to identify vendor names, products and services, their engagements, who owns that relationship, the risk rating, and whether or not that product or service is critical. We want a specific report just about critical third parties, including the products and services they provide, who owns that relationship if there's any open issues, and when those contracts are coming up for renewal. We want a report that identifies personal identifiable information, so any vendor that accesses, processes, transmits, or stores PII and what elements of PII they're touching. We also want to track our risk assessments or reassessments and due diligence to make sure that we have a current status, where everybody is in that process, if they have one upcoming or if they're past due. And any issue management. We definitely want to track all open issues until they are remediated. We also want to keep track of our contracts. So we do need a good contract report that's going to help us understand what contracts are associated to the vendors, their renewal date, and if there's any associated documentation or scopes of work. We want a list of third-party due diligence documentation that we have on file, and we want to notate if any of those documents expire, like SOC reports or insurance certificates. We also want to have third-party performance reports, so what those SLAs, KPIs, or KRIs are. We want to look at those performance trends for 12 to 18 months and notate any issues that are open and what the mitigation plans are. Now, of course, those were just a few examples of the many reports that we can generate, but let's talk about who should be receiving the reports. Again, we're going to have a lot of stakeholders, but for this discussion, we're going to focus on three primary groups of stakeholders. So that first group is our risk committees. Most organizations are going to have some type of risk committee, and we should be providing the risk committee a regular view of program compliance, new and emerging risk, open vendor issues, and items that generally require their attention and their action. The reason for this is risk committees, their very job is to help us address those issues before they become major problems. So anything that is identified as an issue should have a treatment or a mitigation plan established, And we want to present those issues to the risk committee so that they can help us solve them before they end up on a senior leadership or a board report. All right, so move on, senior management or senior leadership, and this would include your executive management team. They're ultimately accountable for the health, stability, and effectiveness of the program, and they need to make sure that it's being executed appropriately across the organization. So they need that information to make sure they can do that. So the reports that we share with them should really highlight the items that need their approval or their influence. And so we provide them a standard set of metrics, including their targets and their trends, to validate that the program is healthy. These metrics should include things like the third-party portfolio size by risk rating, program compliance, significant vendor issues, and new and emerging risks. Open issues that appear on this report should always have an associated mitigation plan. And then finally, we have the board of directors, and they are accountable for that third-party risk management oversight and holding management accountable for the effective execution of third-party risk management at the organization. So the information that we provide to them should enable them to assess if that program is operating as it should be. And it should include that high-level view of the program size, risk exposure, compliance, and material risk issues. Now, while we've talked about reports and we've talked about stakeholders, another way to help you determine what to report is how frequently you need to report it. So if we look at these three frequencies, let's talk about monthly. That might be something you deliver to your risk or compliance department. And the purpose of the information you share at this frequency should really be to provide information and drive action. That might be just sharing your regular dashboard, any upcoming communications for the next month, things that are actionable now that need their intervention or they need to know should be absolutely included on this report, and deliverables that are due. We might also include things about third parties that are onboarding or offboarding. And as we move into quarterly reports, this might be for risk committees. We still want information, action, but we're also including reporting that can help them plan. So we would include that dashboard with some more details, but we also might want to share some progress against any goals or objectives we've been working on, and more data around our critical and significant high-risk third parties, again, updating them with those issues, really talking about internal compliance, upcoming deliverables, emerging risks, any regulatory changes, or any process changes that we may be making. And then at least once a year, we need to provide a full state of the program report for the board of directors. And this is a really soup to nuts view of how the program is performing, any risks within the program, and anything that we really want the board to know or do or influence. So we do want those full program metrics. We want to share our policy updates. We want to review any audit or exam results. We want to give them a full rundown on those critical and significant high-risk third parties. We want to really make sure we give them a full list of the critical third parties, including the services and products provided. We want to review any open issues or concerns, regulatory changes, internal compliance, and we also want to take time to share program highlights and our roadmap. So while I've talked about third-party risk management program metrics, I do want to dive into those a little bit. You may be wondering why you would actually want to create metrics to measure and report the health of your program. And these are really important data points to develop and report on, because they really do help your senior management and board drive action or decisions. They really help support regulatory compliance and can help you identify where the program might need improvement. They can show vendor risk across the portfolio and support requests or resources. They also can help you really demonstrate where the program has been very successful or illustrate where you're having challenges at the program level. And while we might be thinking about just those activities that happen in the life cycle, our third-party risk management program is actually much broader than that. And it might be helpful to think about metrics that help us understand how well our organization is complying with our policy, or the timeliness and quality of vendor owner deliverables, or process efficiency and throughput, or our capacity, and so much more. All right, so you are probably wondering at this point, how do I identify the data points that I need to develop and measure for these program metrics? So we're going to go through this in a little bit more detail, but let me just outline the process for you. The first thing we're going to do is we're just going to think about and identify our organizational or corporate goals for having a third-party risk management program or function in the first place. Then we're going to prioritize those goals and objectives in order of importance. We're going to select the top 3 to 5, and for each objective, we're going to identify life cycle activities or program requirements or other components that we want to measure. We're going to prioritize those components in order of importance, select the top 3 to 5. Those are going to become our metrics. We're going to test our data and our calculations. We're going to set some thresholds. We're going to come back and review it with our stakeholders, and we're going to revise it if necessary. So let's see how this works. So like I said, why do you have a third-party risk management program in the first place? Your answer is going to depend on your individual organization, but for many of us, it will be regulatory compliance and mitigating third-party risk. Maybe it's about cybersecurity protection or protecting our reputation and brand. Whatever it is, you want to identify those drivers. Now you're going to take all your goals and objectives and you're going to write them all down. You're going to list them in order or prioritize them, with the number 1 spot being the most important reason, all the way down to the least important reason. You're going to select your top 3 to 5. In this example, we've selected 5, with regulatory compliance being number 1, mitigating third-party risk being number 2, cybersecurity in the number 3 spot, business continuity and disaster recovery number 4, and vendor performance and value at number 5. Now these are going to be our objectives. Now let's look at how we will start identifying and building out metrics for each objective. So once you've identified your objectives, it's really important to start identifying what metrics are going to demonstrate that you're meeting the objective. Now we, of course, said that regulatory compliance was our number 1 goal. So we'd start thinking about the most relevant metrics or data points that would show that we're meeting that objective. Now these are just samples that we've listed here. You really could go with literally anything, but you want to focus on 3 to 5 meaningful data points that are going to demonstrate that you're meeting that objective. So let's where you might extract those data points. Now, the very first place to look is obviously the activities in your vendor risk management or third-party risk management lifecycle. In each of the stages, onboarding, ongoing, and offboarding, there are specific activities that can be managed. So your inherent risk assessments, is every risk assessment, is there a risk assessment for every engagement? Are you doing due diligence before you execute contracts? Is ongoing risk monitoring occurring? Do you have performance management happening at regular intervals, et cetera? You can look at program operations and program governance for metrics, as well as larger risk management metrics. So were we able to identify risk? Were we able to lower the impacts of risk? Do we have new and emerging risks? All right, here's just some sample metrics by category. So again, let's operational, maybe we want to look at how long it takes us to complete a vendor risk assessment or the number of vendors failing due diligence, right? If everybody gets through, maybe the process is not that stringent. Compliance. Maybe we want to look at how many audit or exam findings we have, or the number of policy exceptions we're making. Or for risk, you know, how many engagements do we have that have past due risk reassessments, or vendors that have had a cybersecurity event. So it really can be any metric that you feel is meaningful and is going to help you demonstrate that you're meeting the objective. Now, I do want to take just a minute to talk about the difference between KPIs and KRIs, and to emphasize that your metrics really should be a good mix of both. So KPIs really confirm that the program has performed as expected, and they're what we call a lagging indicator. They're looking back at something that's already happened. KRIs provide actionable data. They're helping us look forward to prevent risks from getting worse. Now, I have a cool little trick I like to do when I select a metric. I like to think about it in both terms. How does it help me identify that the program has met its objectives, and how does it help me manage risk? So in this example, the metric is percentage of engagements that are risk rated. As a KPI, it shows that I'm operating effectively, I'm complying with my policy, and that there's internal program compliance. But as a KRI, I know that if this number gets high, that it means I increase my number of business interrupting events, the likelihood of audit or exam findings, reputational damage, and financial loss. So for every metric, think about it in terms of, is this better used as a KPI, KRI, or both? The other thing about your metrics is they have to have defined thresholds or targets. We just don't want to count something. If I say I have 98 high-risk vendors, it doesn't mean anything unless I have a threshold, which is to say I don't need more than 100 high-risk vendors, or to say that I have 98 high-risk vendors today, but I only had 70 last quarter. The reason for this is we don't have a threshold, we don't know when to take action. So you need to make sure that with each metric, there's a defined threshold or target. All right, as you have developed and identified your 3 to 5 metrics for each objective, I want you to go in and test your data sources and calculations to make sure that everything's accurate. Review the story you're trying to tell. Is it really telling the story and helping your organization identify and manage risk? Once you're sure that it is, sit down with your key stakeholders in management, present it, review it, and be prepared for some feedback. You may need to revise it a little bit. Now, while you're thinking about that, we are going to take a poll. Jessie?
We are to the first poll question after the break. And this question is, our third-party risk management program has standardized reporting that is provided to the board, management, and stakeholders on a regular basis. Yes, somewhat, no, or not sure. Hillary, while we wait for the results to tabulate on this one, let's answer a question from the audience.
Okay.
We are just starting with reports. What are the top 3 reports you think we should have?
Oh, well, that's a good one. Well, the very first one, hands down, is your vendor inventory report. That should show all your third-party relationships by the vendor name, and if they provide more than one product and service, the products and services they are providing, the engagement, and the risk rating of that engagement, and whether or not it's critical to your organization. That is an essential report. Now, as a subset of that, another really important report to have is your critical vendors report. So identifying all your critical vendors, products and services they provide, the risk ratings of individual engagements, if they provide more than one, who owns those relationships, and if they have any open issues or any other concerns that you'd want to bring to management and the board's attention. And then I think the last report that's really essential is an inherent risk rating and due diligence report. So these are two really important components and activities that we have to go through for every relationship, and we want to make sure that every engagement, every vendor relationship has completed an inherent risk assessment and the level of due diligence that's required, whether that's very robust due diligence or even just checking name, address, etc., before any legal agreements are entered into, your contracts, etc., or before you purchase anything or start any work. Those are the three reports that I would say, if anything else, get those right from the beginning. I hope that's helpful.
Thanks, everyone. Here are those results. As a reminder, in the related content widget, you'll find our How to Develop Metrics in Your Third-Party Risk Management Program infographic. It provides examples of risk goals and objectives and where and what data to measure. Back to you, Hillary.
Okay, welcome back. So let's talk about how to put this information together for those stakeholder groups. So really, it's up to you and your organization. But here's two options that I always like to recommend. One is a scorecard or dashboard format. This is putting your metrics into a single page view. You can use all those graphs and charts, really visually represent that data. Utilize that red, amber, green color system like the stoplight to really help the viewer identify where metrics are outside of acceptable thresholds, right? They clearly show as red. Another way to do it, if you don't want to get that fancy, is to use a single page spreadsheet format. Again, use that red, amber, green color system to help them identify where things are not where they should be, and make sure you clearly call out your data using sections and column headers, bold type, whatever it takes. Okay, just a few things to think about as you move forward. Keep those initial metrics really limited to 3 to 5 per objective, because as you move through this process, you are going to refine them. You may add metrics, you might delete them. So don't get stuck in analysis paralysis. Some metrics may be really obvious, some are going to evolve, you may get feedback. We just don't want to wait until everything's perfect, just get started. The next thing is consult with other internal risk domains because they may have experience with measuring these types of things. They may have a lot of information to share. They're great resources. And then always stay open to that feedback because the idea is to get the best program metrics. All right, just a few key takeaways here. So we know reporting is essential for third-party risk management, and it is meant to inform and drive action. So it needs to be accessible, reliable, repeatable, and so easy to digest. In order to understand how often we should deliver that reporting, we need to understand the audience and purpose of that reporting. And we also need to think about program metrics, how they're essential to measure the health and effectiveness of the program, and that they should be aligned to the organizational objectives for third-party risk. Those metrics should include both KPIs and KRIs and tell the right story and help us with managing risk. So that's going to wrap up this section. And we are going to move on to session 6, which is understanding vendor exit strategies and third-party risk management closure. We are going to be discussing what an exit strategy is, what an exit plan is, the termination part of the life cycle, and third-party risk management closure. So the first question is, what is an exit strategy? Well, the exit strategy is basically determining in advance what your organization is going to do if the critical or high-risk vendor that you're working with should fail or go out of business or is no longer viable for whatever reason. And this is important because you need to understand what you have to do if you need to suddenly offboard your vendor. Now, typical exit strategies include finding an alternate or replacing the vendor. So we would ask ourselves, are there suitable replacement vendors that can actually service our business? And would there be a difference in cost, service, quality, or delivery? Could we bring that activity in-house? Do we have the expertise to do this? Do we have the right resources? We might want to discontinue the activity or remove that dependency. So how would that affect our organization or our customers if we discontinue the activity? Are there any upstream or downstream dependencies on that product or service? And the last strategy might be to do a combination of the above three methods. Could we adjust volumes, delivery methods, or timing? And would that be a temporary solution or a longer-term one? Now, figuring out the exit strategy happens during the planning stage, and that's way before you get into a contract with your vendor. So you need to do 4 things. One is discuss the exit strategies with key stakeholders and even your subject matter experts to figure out which is the best one. A lot of times this is going to just be changing vendors. You need to write out a detailed timeline of what would need to happen to make sure that switch would not disrupt your business and your customers. And you also need to consider if the strategy might change, if it would be different for, say, a planned termination, right? We're just ending the contract. We have the luxury of time versus an unplanned termination, like a vendor bankruptcy or natural disaster. Would you take a different strategy? You also want to document your decision. So what drove the decision, what the results should be, who was involved in making that decision, and when the strategy needs to be reviewed again. Now, as a best practice, the strategy should be reviewed periodically, at least annually, with the same stakeholders and subject matter experts to make sure it's still relevant and actionable. Well, let's talk about an exit plan. What is an exit plan? Well, it is the documented instructions and processes for implementing that exit strategy. And they contain all the details, including the roles and responsibilities for both your organization and the vendor, the specific tasks and activities and the order in which they should occur, all the timing and schedules for those activities, all the inventories of equipment or assets to be returned, data to be returned or destroyed, all the vendor access that needs to be revoked for data systems, networks, physical access to facilities, any stakeholder communication plans, including required notifications to vendor staff. Keep in mind there are many legal obligations that vary by state, and contingency plans in the event that the vendor can't or won't fulfill their obligations. Now, as a best practice, the best time to outline this plan is during your onboarding process, because you're taking all those steps to get that vendor up and running. It's perfect time to detail what it took to get them in place. Those are basically the steps that you need to reverse to offboard them. Now, this approach is really the best because it makes sure you don't miss anything and you have a realistic expectation of time. It also helps you prevent any errors or missteps that can happen during really high pressure, unplanned terminations.
The next poll question is, my organization has a documented exit strategy for each critical vendor. Yes, some, no, or not sure. Hillary, here's another question for you from the audience.
All right.
Does our organization have to have an exit strategy for all vendors or just critical and high risk?
That's a good question. So instead of telling you yes, it's just critical or high risk, I would say you have to have a vendor exit strategy for any vendor that's going to materially impact your organization if you need to suddenly cut them off or make a change. In most cases, that is going to be your high risk and critical. But you might have some moderate impact vendors that do need to have a plan associated with either transferring that business or bringing it in-house. So you do absolutely need them for your high risk and critical, but keep in mind you may need them for others as well. It's really up to your organization. I hope that helps.
Great, thanks so much, Hillary. Just a reminder, if you wish to receive the CPE credit for today's session, you must answer all poll questions that appear on your screen and also be in attendance for the entire live session. If you have any questions along the way, please remember to add those to the Ask Question widget, and we'll be happy to assist and try to answer your question live. Please get those responses in quickly, as we will be closing this poll out in just a few seconds. Thanks so much. On your screen now, you will see the poll results. Thanks again, everyone, for taking the time to answer the poll. Before continuing, I would like to direct your attention to 5 steps for a successful vendor exit strategy ebook back in the related content widget. It's available for download. Hillary, back to you.
All right, let's talk about this exit plan a little bit more. So after we've determined our exit strategy, we're going to create a draft version of the exit plan. We're going to do 5 steps to get there. First of all, we're going to document all those activities and details that we use to bring that vendor to business as usual, right? And don't forget any approvals or stakeholder communications that we use. We also want to write out a detailed timeline of how long it realistically takes to perform the necessary actions, right? Don't use, timelines like 90 days, 60 days. Really be thoughtful here, because once you put it in writing, people will have expectations. And then again, consider those various scenarios. If, for example, it's an unplanned termination, there's a bankruptcy or some other issue, you may only be able to execute certain steps in the plan. So you may want to highlight what is mission critical to minimize impacts to the business. Think about and document those contingencies. A very important scenario to consider is, what if the vendor cannot fulfill their responsibilities? A lot of times the vendor may know they're losing the contract and their staff starts exiting. They may not have enough people to fulfill all their obligations. So you need to think about what you would do to safely and soundly exit that relationship in that case. Now, you're going to want to complete a fully documented drafted plan that includes those contingencies. We're going to store this draft plan with the vendor record to make sure it's accessible to anyone who needs it if it becomes necessary. All right, let's talk about roles and responsibilities. So let's start with the vendor owner. They are absolutely identifying that exit strategy and confirming it with stakeholders. They need to draft that exit plan and review and update both the plan and the strategy as required. As a best practice, that's at least once a year for critical and high-risk vendors. They also need to finalize that exit plan before termination, and they're responsible for executing the plan during termination. Management and the board need to consider risks involved with critical and some high-risk vendor exits. They might also be approving those exit strategies and plans and ensuring that exit strategies and plans are completed and current. The third-party risk management team or vendor risk management team would ensure that exit strategies are documented and accessible, as well as the plans are the same, and provide reporting to management and the board on exit strategies and plan status for those critical vendors. They would also take a look at the strategy and review to make sure that they've been approved as appropriate, and confirms that finalized and approved plans are available, they're ready to go before termination. We also have SMEs and some stakeholders that might provide input or approvals on both plans and strategies, and might have some specific responsibilities in vendor exit plans. An example might be InfoSec, making sure that data destruction has been done appropriately. All right, now that we understand exit strategies and plans a little better, let's get into vendor termination. So all vendor relationships are eventually going to come to an end, whether that's because the contract's naturally coming to an end, whether you just want to move on to something bigger and better, a different product or pricing, or you're terminating for a cause. When you're dealing with vendors who are underperforming, maybe they have an increased risk or anything else that is undesirable, it might seem like termination is your only option, but it is always really important to conduct a thorough analysis before you decide that that is actually the case, because there are cases where termination is not the best action. And I'm telling you this because if we just point at someone and say you're fired, or we don't handle that process appropriately, there's all sorts of risks that can occur, everything from financial to legal to information security, compliance, reputational risks that can not only affect us and our customers, but also the vendor. So it's really important to take a very clear, systematic approach to vendor terminations to ensure that we know what the risks are and that we can mitigate. All right, let's assume that a vendor has done something that makes us want to terminate that contract. Whatever that reason is, we want to end that contract prematurely. So what do we need to do? Well, the first thing we need to do is validate our judgment. Is this the right thing to do? Have we done everything we can to fix the relationship, work on the performance, given them ample opportunities to correct the problem? Do we have documented evidence that termination is necessary? Can we show that they've failed the performance, violated the regulation, etc.? We also want to make sure that we validated that exit strategy. So if we want to replace them with a vendor, do we know that that vendor is still willing and able to take our business? And how we reviewed our exit plan to make sure it's still reasonable and actionable. All right, assuming the answer is yes, the very first thing you want to do is to review your contract. We need to make sure that we're clearly within our contractual rights to terminate and that we're following any requirements. That includes termination notices and methods. If we don't do this, we may be in breach of contract, which could result in litigation. We also want to do a very careful financial analysis to consider the cost of exiting the relationship, understanding the termination fees, any potential decline in revenue, the cost of onboarding a new supplier, etc. And we will want to be very thoughtful and determine how we're going to manage any issues that might pop up during the termination. All right, so all your ducks are in a row, you've reviewed the contract, you've done your financial analysis, it is time to notify the vendor. The very first thing we want to do is have that hard discussion. Now, there are cases where legal may advise you not to have any further contact with the vendor. They're very rare, it does happen. But in most cases, you do want to notify the vendor verbally before sending a written notice. This is professional courtesy, and I might add, no matter what the vendor's done or how they've acted, always maintain a respectful and professional demeanor. It's your organization and your personal reputation on the line. Make sure you let them know when they will be receiving a written notice, and make sure that that formal written notice is provided as it's required in the contract. Many times that will be to an attorney, a home office, etc. But regardless, always make sure that your representative gets a copy of that written notification of termination as well. Once that written notice has been delivered, make sure you schedule a meeting with the vendor to review the exit plan and answer any questions they may have. They may have suggested or requested changes to your plan. If it's not too arduous, try and be flexible and allow those changes, but always take notes and confirm everything in writing. You also want to make sure that you keep regular meetings or maintain communication, because even though this situation never feels good, keeping it professional, making sure that everyone's staying on top of it will just make it a better situation for everyone in the end. And then always provide a detailed inventory of any equipment or assets to be returned. Make sure you're very thorough about what they're to do with it, how they're supposed to label it, package it, ship it, store it, move it, etc. And speaking of details, we want to be very detailed regarding how any data is to be returned or destroyed. And if you have any questions about this, work with your InfoSec team. If your vendor is expected to destroy data, Make sure you provide details as to the method of destruction or how they're to verify that it has been destroyed. You also want to make sure that you are being very detailed and diligent about vendor access and shutting it down. Keep in mind that that vendor is going to need some level of access throughout the termination, but you want to limit it as much as you can. Make sure that any vendor staff that have already been terminated, access is removed immediately. That's access to any data, networks, systems, or physical locations. And really hold the vendor accountable for letting you know who needs access and exactly what access they need. And then throughout the process, continue to update management and the third-party risk management team if you're not already on that team, because we need to make sure that everyone's getting good regular updates, how it's going, and if there is any additional resources or support that is needed.
We are to our last poll question of the day, and that is, does your organization have a formalized and documented vendor termination process? Yes, no, or not sure? Hillary, here is another question from the audience.
All right.
Who should be in charge of vendor termination?
All right, well, I think it's important to understand it's not about who's in charge, but really understanding the different roles and responsibilities that take place. So first of all, there's that vendor owner, the line of business, who might be determining that the vendor is not really performing well, or they want to move on to something else, or they just want to let that contract end. They would be responsible for identifying that exit strategy and that exit plan and doing all the work associated with those two activities. You also have most likely your legal team or internal counsel who would review the contract with that vendor owner to make sure that we're within our legal rights to terminate and that we can do that within the specified time frame. You may have other people who are involved in that termination. Maybe your info security team is going to help verify that data was destroyed or returned. But when it comes down to it, it is kind of a team sport, but the vendor owner and that line of business, they own a lot of those activities and have responsibility for making sure that they all get done. And that includes things like having a contract review with legal. I hope that answers the question.
And here are those results. Thanks again, everyone, for answering this question. Before moving on, back in the related content widget, we have our Offboarding a Vendor Toolkit. This toolkit contains an ebook, infographic, and checklist to assist with your vendor offboarding. Let's continue with the presentation. Back to you, Hillary.
All right, so hopefully your termination went really well and you were able to execute your strategy as you had planned. But there's also something else that we should be doing as soon as we terminate that vendor, and that's to really take a time out and review any lessons that we learned. You know, a lot of times when we run into issues with our vendor, it's a good time to ask ourselves if our organization could have done anything differently for a better outcome. Could we have provided better instructions for the vendor? Could we have managed their performance any different? Were there any red flags that might have popped up that we could have managed earlier or that we might have missed? Whatever it is, make sure to document your findings and share them with your team for next time. Okay, so we're coming to the end of the termination process, and this is what is largely a bunch of administrative work, but that does not mean that it's not important. So one of the first things that we need to do is review all the final invoices carefully. Now, I have seen this personally, especially in the instance of where we have terminated a contract prematurely, where the vendor tries to sneak on a lot of additional charges that were neither approved nor agreed to. So make sure you're reviewing all of those invoices and approving them. And when you have approved the last invoice, let accounts payable know this is the last invoice. We are not paying anymore. We also want to make sure that we are updating the status of the vendor in all systems of record. So that's not just the accounts payable, but if you have a separate contract management system, procurement and sourcing systems are also very important, especially if we've terminated that vendor because they did something we didn't like, they had poor performance. We don't want them being invited back in for another RFP, et cetera. Of course, we want the status updated in the third-party risk management system, and of course, those access management systems as well. We want all of the vendor records to be organized and properly stored. They should be retained by the third-party risk management team as sort of the official record, and they should be accessible for any legal, audit, or exam purposes. All right, as we wrap up our section on terminations, let's look at some key takeaways. So the first thing is that exit strategies and plans are really going to help your organization determine what to do if that critical or high-risk vendor suddenly becomes unviable, but also outline the steps you need to take if that happens. And for these strategies and plans to be effective, they really need to be documented and reviewed regularly to make sure that they remain relevant. It's also important to understand that different scenarios might require different exit strategies and plans. And the exit strategy should be defined before the contract is executed, and they need to be reviewed at least once a year. Your exit plans should be developed as a draft version during onboarding and reviewed at least once a year and finalized before termination. Keep in mind that even the simple terminations are risky if we don't handle them properly. And we always need to review the contract and understand any financial implications before we decide to terminate. And even if we're terminating for cause, we need to make sure that we can justify our decisions and our actions. All right, always try and notify your vendor verbally before sending that written notice of termination. This kind of dovetails into the next bullet, which is always treat the vendor with respect and professional courtesy, no matter what they've done or how they've acted. Remember, it's your personal brand and your organization's reputation. Follow your exit plan. This is super important. And right from the beginning, establish regular progress meetings with that vendor up front so you can escalate any issues quickly or address any problems. During a termination, we just don't have a lot of time to get things back on track. Make sure that management is getting updates, especially if it's related to a critical vendor, and review all your final invoices very carefully before authorizing any payments, just to make sure nothing sneaky is going on. At the end of the day, you've got to update all your systems and store records properly. And then kind of that sunset review, really take time out to think if there's anything your organization could have done better or different, and share your findings for next time. And with that, I thank you for attending this session, and I'm going to turn it back over to Jessie for some more information and Q&A. Jessie?
Great. Thanks so much, Hillary. Before we dive into more questions and answers, I would like to thank everyone for attending our third and final day of boot camp. We appreciate your participation, engagement, and questions. I would also like to thank our experts from today, Raman, Christine, and Hillary, for their time in sharing some important information. On your screen now, you will see our upcoming webinars. On April 30th, our Protecting Your Credit Union with Vendor Risk Assessments webinar, and on May 7th, our Vendor Contract Management for Beginners webinar. We hope you'll be able to join us for those sessions. A link to register for those is in your copy of today's presentation slides. Let's now go ahead and answer some more questions that have come in during this session. Okay, Raman, this next question will come to you. If a private vendor does not provide financial information, what can we do to perform due diligence?
Thank you, Jessie, and thank you all for joining today. This is a common question that we get when you're dealing with private vendors, which can make up a pretty large component of your vendor base that you want to perform a financial health review on. So in essence, there's some multi-step and multifaceted approach you can take. First, you want to ask for simpler, bite-sized pieces of information that fit within your oversight needs or your due diligence needs. So if a vendor isn't able to provide you a full audit or even unaudited financial statements, ask for specific components like their revenue, like their cash availability, or just even ask the question directly to them on whether or not they have enough liquidity to support your contract and their obligations for at least the next 12 to 18 months. Always keep in mind that you can deal directly with the vendor and try to get them on a phone call or even give you just a financial letter of health. So that's always a good option. But beyond that, you can always use public-facing reports or available reports like Argos, Dun & Bradstreet, so you can get at least an indication of their financial health using those public data sources. Thanks for the question. Back over to you, Jesse.
Great, thanks, Raman. Christine, this next question will come to you. Is the interagency guidance the best regulation to follow even though we aren't in financial services?
I would say that it is recommended to follow the interagency guidance because it's one of the more comprehensive regulations, but still basic enough to apply to any organization regardless of your industry. And remember, at this point, the interagency guidance is still less than a year old, so it wouldn't be surprising if regulators in other industries begin to model their expectations to these guidelines. So I would say, if you're following the interagency guidance, even though you're not in the financial industry, I would say that you're going to be better prepared for any additional regulations that might be released in the future.
Great, thank you. Hillary, this next question will come to you.
Okay.
Is it industry standard for the Vendor Management Office to obtain and retain evidence of contractor access revocation, return of data, property, etc.?
As a best practice, it really is important to store all vendor records, whether it's due diligence records, contracts, everything to do with that relationship within that vendor record. And as a best practice, the Vendor Risk Management Office or TPRA office should hold that because when the auditors, examiners, and even legal teams come in to look for vendor-related information, that's the first place they're going to go. So yes, that is the best practice, and I advise putting your records in a way that third-party risk management, vendor risk management can access them, keep them organized, and that would help you stay ready for those questions, or if you just need to refer back to it in the future.
Great. Raman, will hop back over to you for this next question. How should we define criticality to determine what type of financial due diligence we should perform on a vendor relationship?
Ooh, that's a tricky one. My short answer is it depends on your organization, but without just stopping there, because probably is not the answer everyone wants to hear. The simplest way and probably a best practice to keep in mind is from a criticality level is something simple. If the vendor were to be disrupted or if the vendor were to go down, either because they don't have good financial health or they have some sort of issue across the organization about that domino effect that we talked about a bit earlier in my presentation, that is a very easy way to determine whether or not they're critical. So if there's going to be disruption to your business, even if it's not massively significant, that vendor has higher criticality level than, say, someone who is, or that vendor that is less impactful to your overall operations and your ability to continue to perform services for your own customers. So that's a very simple way to look at it. But again, every business is different. Every third-party risk management program and risk management program is different. Your board and your governance structure may have loosening guidance or maybe some tighter guidance on what you deem to be critical. So having that flexibility available is important. So just keep that in mind. But just focus on some of the simple stuff if you're just getting started on doing financial health reviews and defining what's critical, and that notion of if it causes disruption, they're definitely critical to your business.
Great. Christina, we'll come back to you for this one. Can you give an example of how an organization may stray from the guidance?
Sure. I know that probably sounded a little confusing because, the goal should be following the expectations in the guidance and not looking for ways that you don't have to comply. So just to give, or just to use the interagency guidance as an example, I mentioned before that the text states that all third-party relationships are in scope, even if there's no contract involved. And further in the guidance, you'll see the life cycle, which includes the activity of third-party selection. So if you think about it, this selection process isn't going to apply to some of your third-party relationships, like government entities. You obviously can't choose which regulators are governing your organization, so that specific part of the guidance wouldn't apply. And what's most important is to document your reasoning for why you're not following certain parts of the guidance so you can show regulators and be able to defend your processes.
Great, thanks so much, Christine. Unfortunately, that is all the time we have left for questions today. Thank you, Raman, Christine, and Hillary for taking the time to address some of those that came in. Any questions we were unable to answer today, we will address with you offline. We would like to thank all of our presenters over the last 3 days and to all of you for attending. We hope you found the bootcamp sessions valuable. As a reminder, you can ask even more questions inside of our third-party think tank, an online community that is dedicated to third-party risk professionals and free to join. Just because the bootcamp has ended doesn't mean the conversations and questions must. Post your questions at thirdpartythinktank.com and see what your peers have to say. In the community, you'll find thousands of free educational resources related to third-party risk management topics, including vendor financials, regulatory requirements, metrics and reporting, and exit strategies. If you'd like to become a member of Third Party Think Tank, you can register on the site or shoot us an email and we'll get you registered and send you a link to set your password. We did record each day of the bootcamp, and those recording links will be provided to you in a follow-up email that you will receive tomorrow afternoon. Also in that follow-up email will be the survey link for you to request the CPE credits. Once again, a big thank you to all of our experts for another great bootcamp, and thank you to everyone in our audience for taking the time to join us around our virtual campfire and listen in. If you submitted a question, but it was not answered live, don't worry, we will follow up via email. On behalf of VidMinder, it has been a pleasure. Thank you all and have a great rest of your day.